Unit 3, the financial planning process. The financial life cycle. Children under the age of 18, they are normally dependent on parents who do take responsibility for financial planning. For example, education costs, the first car, or the wedding. You'll also have students who have little opportunity for saving. They may have to consider how to repay student loans. Young adults in employment, first experience of regular income, probably a few responsibilities, saved towards emergency fund or a house deposit. Insure against inability to work due to sickness and accident. Young families, they have mortgage costs, typically 1/3 of net income. They need to protect income of both partners, many other costs of setting up home. Loss of one income, cost of raising children, approximately $1,500 per child per annum. They need to ensure lives of both parents planning for school, for university fees. Mature households. The family has grown and left home. Maybe surplus funds available after outgoings are met. Possibility of receiving inheritance. Pension planning starts to become very important and costly, especially as a result of changing jobs often. Your mortgage may be paid off. Retirement. When to retire? Can you afford to retire? What level of income do you require? What standard of living do you need? To convert capital into a lifetime income, what planning needs to be done? The modern life cycles. We're going to give you an example on this one. Bob was 82 this year. He has a lovely fiancée called Carol and is languishing up in France, drinking wine and living the high life. He has a small pension, a bijou cottage near Cognac, and is full of fitness. Now, traditional life cycle profiling would have him as a retiree looking to invest his thousands to supplement his pension so he can relax by the sea. How wrong could this be with Bob? And he's not unusual. It's an old-fashioned and out of date. Instead, we should be categorizing customers by events, such as, in no particular order, passing a driving test, health issues, divorce, marriage, a new child, an adopted child, a midlife crisis, purchase of a 1000cc motorbike, entering university, their first job, redundancy, setting up an own business, a second marriage, semi-retirement. And, going forward, I think each customer does need to be categorized accordingly. Nobody should be looked upon as the same as any other client. Every client is an individual, and that is exactly how you as an advisor would have to elaborate and, of course, have your conversation with them to ensure that when you are having your initial interview with the client before making a recommendation, you know exactly what their lifestyle and their life circumstances are prior to going into a deeper conversation with them. The fact find. This is probably one of the most important things you will do with your client. First of all, it protects your client and you. This is exactly where you conduct your research and you know exactly what the client wants. So prior to you going out and researching the market and, of course, looking for exactly what you need to get the customer from A to B so that they can purchase their property, you're going to collect a lot of information off them. That information might well be their family details, their employment details. Are they currently insured? Do they have life insurance? What their employment is? How long have they been employed? Do they have savings? If so, how much? Where has that savings come from? This is your time to ensure that prior to going and looking to secure a mortgage or loan for this particular client, you know exactly what you need to know about this client and their household. Purely because if they are purchasing a property alone, you need to know exactly what their outgoings are. Do they have any dependents? Will they have anybody else living in the property who may be party to the mortgage or may want to be party to the mortgage? Do they have a will in place? All of these things have to be carefully categorized, carefully written down and considered prior to going forward and making any recommendation so that you do know your client. So there you have it, the financial life cycle. We've briefly covered exactly what kind of clients you may well come across. However, again, that is very, very brief discussion for myself. So I strongly recommend that you do have a look through your text material so that you can fully understand exactly what other kind of clients you may come across, what circumstances you may come across. Prior to making any recommendation to a client so that they can make an informed decision, you do need to make sure that your fact find is fully accurate so that you know exactly what that client wants, what they need.